Good morning. Are you guys ready? There we go. 0.7% to the downside, half an hour away from the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Rebecca Chung-Wilkins.
Our top stories this morning. Asian stocks and US futures slide following a sell-off on Wall Street, fueled by growing anxiety over tariffs and a potential recession.
Now, media reports suggest a meeting between President Trump and President Xi Jinping is possible in the coming months amid these rising trade tensions.
Plus, an exclusive with Alibaba.com's president on how the company is navigating trade policy uncertainties and the potential for more AI applications.
This industry is moving so fast, and a lot of people doing a lot of innovations.
Good morning and welcome to the program. Hope you're all well and rested. It is one of those days where, certainly we'll just let the day progress and see what happens here. No amount of makeup and mascara will be able to cover up really the losses we're seeing today. So a couple of markets are coming online, and the reason we're seeing 1.5% drop now on the Asia-Pac index is really you have, Japan for obvious reasons, 2.5%. Kospi's down by 2%. Oz and one market coming online is down 2.2%. That's Taiwan. You don't see Singapore, but you're also getting, of course, some pressure coming through there as well. The good thing, question mark, I'm leaving that open, is somewhat of a softer dollar following the move up yesterday. And you do see the euro pushing slightly higher. Although, when you get a move like that on S&P futures, the NASDAQ futures, you just saw at the top of the show, down about 1%, does suggest that we might see more downward pressure going into the rest of the session. Do we have VIX futures as well, please, to show our viewers? I'm just going to have a look at that right now. For our producers, that's UKA or UXA index, just to give you a sense of what's happening there. Big spike overnight. I'm going to read that out for you right now. We are looking at, a further spike of a couple of points here on VIX futures. Thank you so much. There we go. 1 point. 26 is now where we are in that. Flip the boards, please, and have a look at, let's, take a step back. If you were looking for a dip to buy, there's the dip on your screen. The question is, do you buy, or for now, do you say buy? 26% down in the SOX index. We're nearing a bear market on the Russell 2000. 15% is a bad day away, really, on the NASDAQ 100. We'll talk more about that in a moment. Citi just put out this note that they're cutting U.S. stocks. They're raising China on this pause in U.S. exceptionalism. We'll talk more about that story in a moment. The damage overnight, though, does seem to suggest we are going to get some losses and pressure going into the open today. Big drop on Baba and Tencent. Bilibili and Kingsoft are ones to watch as well, given, of course, what tends to happen there will tend to happen here in Hong Kong. And really, your futures are doing this. So you're going to have two massive things collide when the markets open in Hong Kong. One is this global sell-off against this wall of money that's coming through the Stock Connect. In fact, a record amount that we had yesterday across the southbound flows here.
Yeah, that's right. About 3.8 billion US dollars coming through. That is a fresh record for those southbound highs. And just to put it in context, last month, daily average was 24%. That compares last year to about 16%. You really see the gulf of difference here that onshore investors are making. Yeah,
and I think that also tells you about the preference A over H shares. We can get to the minutiae in just a moment here. In fact, let's get a sense of what's going on across these global markets and bring in the head of Asia Pacific Equity Strategy at HSBC, Herald van der Linde. Good morning and nice to see you.
Good morning, David.
Good morning.
How was your morning call today?
Our morning call, 7:15, we normally kick off. Yeah. Now, of course, there's talk about what happens in the US. Now, you brought up just an interesting number. $3.8 billion came in yesterday from southbound, right? Yeah. The amount of cash that sits onshore in China is 22 trillion US dollars. So if we just take a slither of that, we're talking about $100 billion.
That's in savings, right?
That's in savings, deposits and these sort of things, right? So if you take off a slither of that, you have $100 billion that can flow into the Hong Kong market, and it wouldn't hardly change even that number, right? So Chinese households see an enormous amount of cash. That will, I think, eventually could provide support to this market. But yes, of course, today is a lot of flows around the world. The US comes down the largest market, so you get some recalibration. That's not going to be good for equity markets across the whole planet. Yeah, tough.
It sort of seems like just overnight we've switched the conversation from talking about US exceptionalism, perhaps with some caveats, to now whether or not we're going to see a recession. There's a dramatic turnaround in the nature of the conversations that are happening this morning in Asia.
That is right. And it's not just that. I think there's another thing that happened earlier this week as well. So the president was saying, listen, yeah, there might be growth issues. The central bank has stated early this week, well, I don't think it's really time to think about cutting interest rates yet. So we're having a situation that is just not good for equities. You have relatively high rates. They might come down over time, but not maybe immediately. And you have growth worries. And, of course, people then say, oh, that's not good for equities. And here you got the sell-off in the U.S.
And what gives you confidence that if the U.S. does enter a bear market, a recession, what have you, why will we be okay in the Asia-Pacific? Isn't it bad full stop for global equities?
So, yes, we will. If that market jitters, we will jitter as well. Okay. However, I think there are really interesting things going on in China at the moment. Increasingly, we got the perception that there is a shift in China, almost like we've had 3 or 4 years of bad markets, that actually we've hit the bottom late last year. And things are improving. We see this in property. We see industry consolidation. Companies are not investing, so they're returning cash to shareholders. If you invest in Chinese equities, you get 5% just on dividends already. That's not even the growth that could come out of it. So there's a lot of subtly positive things going on in that market. So I feel very confident by being overweight on China.
So you're overweight on China, but what does it take to unleash those savings with serious momentum? I mean, particularly in the onshore market.
Yeah. So they're sitting on 22 trillion because there's not a lot of confidence. They don't want to invest in property because in the last few years that was not a good investment, right? They didn't invest in equities because the stock market was down the last few years. So what did they do? Put it in deposits or in some sort of fixed income fund, and that therefore reduces interest rates. That's exactly what we've seen in China. So that confidence needs to come back. And how does that come back? Now, market performance, a recovery in property, which we, by the way, starting to see in China, right? So we've had, since October, I think, last year, every month things are improving a little bit. If that confidence come back, then people say, listen, I got $1,000 or I say $100 in cash in my deposit. Maybe I take $5 or $10 off. Maybe I should be in equities. And that's what I mean. It's just a slither that they take off. But because we're talking about such enormously big numbers, that can have quite an impact on the market. So confidence needs to come back. And policies, of course, fit that as well.
Now, I remember, when did you guys go overweight China? I guess you guys were very early on.
We were very early on in China, and actually on the property cycle as well. So much so that we got quite a lot of pushback about a year ago. We have in about 2 or 3 weeks' time, we have a big conference, GIS conference here, HSBC in Hong Kong. I remember last year when we talked about it, said, listen, things are really bad, but you've got to also understand it is incredibly cheap. You can buy a bank for 3 or 4 times PE, and they will give you 7% or 8% in cash on dividend. So why not? But yeah, there's no particular catalyst. So now we're a year later, and sentiment has dramatically changed.
Yeah, and a lot of your peers are catching up. I just mentioned Citi just came out and said almost the same thing. So my question is, based on the observations that you have or the data, this resurgence in the market in China is coming at the expense of which markets? How are people funding this?
So I think this comes out of cash.
Okay.
But that's the China story.
Yeah.
And we see a global rotation. You see money has left the US. Europe, of course, has benefited from that. And that's moved into emerging markets. So that is coming as well. And within Asia, you see interesting sort of shifts as well. So Japan is down. So you see money probably from Japan and India going into China as well. So there's multiple flows that are all coming at the same time, from cash into equities, from global equities in emerging markets, and within emerging markets, a sort of rebalancing that's taking place as well. Yeah.
You're seeing US cash heading into Chinese markets?
I'm not quite sure about US cash. If I talk about cash, global cash in a sense, but I think the appetite in the US for Chinese equities probably has taken a step down over the last couple of years. On the margin, that will change. Some people say, hey, tactically, I want to be in that market. But we see a lot of interest also coming out of Europe, but within the region as well. Korea, Taiwan, you name it, India.
Well, speaking of Korea, Taiwan is one market that's coming online right now. How do investors need to be thinking about today's dip in those markets, like
Taiwan and Korea.
Like Taiwan and Korea, for example, which were the favorites and the darlings.
Yeah, so we have preferred Korea over Taiwan since the beginning of this year because Korea was simply much cheaper. And the worry I had with Taiwan is that everybody liked it. It was a really crowded trade, and there's only one stock that everybody was in. So if you look at the holdings in, say, TSMC, there were 10% of Asian portfolios on average. That means that if you run an Asian portfolio, you get 10% in one stock. You get single sort of concentration risks. Risk managers will say you can't buy more in this stock because we have too much. So we felt there's a risk to Taiwan to a certain extent, but the growth story in Taiwan is better. So then some rebalancing needs to take place. So we prefer Korea for the moment.
Okay, Herald, don't go anywhere.
Good.
We'll have more with Herald van der Linde, Head of Asia-Pacific Equity Strategy at HSBC. And we'll be thinking and talking more about geopolitics too. Alibaba.com President Kuo Zhang says he's not worried about any impact on business from Washington's tariff policies. We'll hear exclusively from him later.
But ahead of that, media reports suggest a meeting might be on the cards for Donald Trump and Xi Jinping. The details of that potential coming together, coming up next, counting down to the open of trade in Shanghai and Shenzhen, and here in Hong Kong, futures are pointing to, there we go, yeah, quite a dip in the open, 18 minutes away. This is the China Show.
Good morning, you're watching the China Show, and we touched on this right at the top of the hour, but it's these two big narratives that are playing out. On the one hand, there's weakness in the US spilling over into Asia hours. On the other hand, it's coming up and abutting, Dave, onto these really robust southbound flows that we were talking about earlier. Elsewhere, a couple of sectors in focus. I'm just going to pick out one sort of particular story here that you might have missed overnight, which is this battery story. So we had legislation passed in the House overnight that could essentially mean that some of these Chinese battery makers will not be allowed to sell and operate in the US, Dave. That's come through. Elsewhere, we are also looking at the closing day of the MPC after, of course, this rush of policies that we've had coming through. A lot of discussion, and really the AI trend, that AI craze has fueled sort of optimism and sort of positive commentary and really helped out, I think, policymakers in Beijing.
Yeah, more on that note that you just mentioned there, Rebecca, that bill is HR 1166, which is interesting because that really segues nicely into this potential meeting that's been reported between the two presidents. You have the U.S. and China, of course, reportedly across different media discussing a potential summit between the two. Wall Street Journal, you also have, I think it's the SCMP that's also reporting in terms of just the different timings of that coming together. But yeah, go ahead. I'm just going to give
you a little bit more specifics on that and correct myself on that bill. So Department of Homeland Security barred from buying batteries from companies, these 6 companies linked to the CCP party there. But yes, as you say, this meeting between Xi and Trump potentially coming up sort of reminds me, in fact, of these meetings where you had Putin and Xi both celebrating one another's birthdays in the past.
Yeah, and these two actually have, in case you didn't know, meetings just days apart, if not one day apart. Min Lo, our China correspondent, joins us from Beijing about this potential birthday summit, Min.
Yes, June 15 is the birthday of President Xi, in case you're curious, and President Trump's birthday is one day before, on June 14. So Wall Street Journal is reporting that there could potentially be this so-called birthday summit in June, but SCMP, however, reporting that this summit could take place much sooner, as soon as next month. And of course, April is that deadline for that U.S. investigation into China's trade practices, which Trump had ordered. That report could potentially be the basis for even more trade actions on China. And so far, we know China has been keen to have more dialogue with the United States. The Commerce Minister Wang Wentao last week flagging that he had already written a letter to the U.S. trade representative, and there appears to be some level of frustration and not being able to engage with officials at this point. A Chinese source for SCMP saying that China is finding it more difficult to engage with U.S. officials under the Trump administration compared with the Biden administration, and it seems like U.S. officials at this point aren't able to hold a dialogue because they are not able to articulate the China strategy at this point, all the changes happening in Washington here. And of course, there's also the question of where this summit is going to be held. SCMP reporting that both sides wanting the other party to travel to their own country. Trump, for example, hoping to hold this summit in Mar-a-Lago in his estate in Florida, but Beijing wanting a more formal summit in China. And of course, after watching what happened to Zelensky when he went to Washington, that public dressing down there, nobody watching that will want a repeat of such a heated incident that could make China look like a supplicant to the United States. So, of course, if Trump travels to China, then China would have greater control over how President Trump is being received. There would be a lot of symbolic significance in terms of whether China rolls out the red carpet for him, as they did in 2017 when President Trump came to visit, and China had then hosted him to a meal at the Forbidden City. But of course, the atmosphere around this potential summit this time around, 8 years later, is very different now.
Okay, that's our China correspondent, Min Lo in Beijing, with fantastic reporting for us through the week, through the MPC. And still with us is Herald van der Linde, Head of Asia-Pacific Equity Strategy at HSBC. I mean, let's pick up on that point about the US versus China here. We have now these anxieties about the US and what the Trump tariffs are going to mean. On the other hand, we have China and Beijing seemingly remarkably calm about the US tariffs that are coming through, and that's reflected in the markets. Is this a short-lived dynamic? Is this a temporary kind of, blow up in the US versus China?
No, I think there's something more going on. So the tariffs will impact China, but the impact actually on markets is fairly limited. So the earnings exposure of Chinese companies that actually sell into the US is about 1%, maybe 2%. Say that's 2%. You put a 50% tariff on it. I'm actually making a big number here. That's 1% of your earnings, assuming that the Chinese take the hit on that. So the impact of the tariffs on the earnings in that way is not so big. Where the impact comes from is actually from a dollar or interest rates, bond yields. But bond yields have come off. The dollar is weakening. You guys were talking about it this morning as well. So that's actually supportive for emerging market equities and Chinese equities. So so the response, I think, is more structural than that. Yeah.
I want to ask you about the case for this rally to broaden out in China beyond tech, because you could make that case in the U.S. because the economy, and who knows, but the economy was doing relatively better in the U.S. than it is in China.
Yeah, correct.
What's the case for the rally to broaden out in China if we're not getting aggressive signs yet that the economy is, in fact, the inflation print on the weekend is improving?
I think there's a very strong case that they will broaden out, and that this will be a slow sort of process. So we've had the tech companies rally here. Property is turning around, but of course people are really worried about that sector because the last couple of years has not done so well. And you guys have been reporting about this. All property companies have disappeared. So gradually you see interest coming back. But what I think is going to drive it further is that we see significant consolidation in a lot of industries. The number of electric car manufacturers in China was 4 or 5 years ago 70, but the vast majority can't sell their product, struggle, or don't make any money. So they've effectively closed shop. And that's why the number 1, 2, 3, 4, 5 in China, they're gaining market share. So you see consolidation in EVs and autos. You see it in consumer markets. You see it in property. You see it in solar panels. You see it in, I can give you 4 or 5 other sectors as well. So, and that means that profitability could be supported as well. So I think that's going to be a longer, slow driver for Chinese equities over the next 1 or 2 years. Broaden it out.
That overcapacity story is important and that consolidation story is important. Do you see that kind of reaching an apex this year, or is this a slow rumble that we see over 2 or 3 years?
My argument is that we don't know yet, but probably we've already passed the apex. But we'll only discover that maybe in 12 months or 2 years' time. But I see so many signs, small signs of consolidation in many industries. Not too long ago, 2 financial giants said we're going to merge together. So my suspicion is that actually that is already underway, but that the real evidence, the realization, hey, this is a different sort of industry now, it looks differently, that will gradually come over time. Yeah.
Right. And just quickly, I know you can't talk specific names, but just to ask you, if it is a consolidation phase across many sectors, that it's a slow grind, we don't know who's going to get eaten up, who disappears. Is the play just buy the one, the top 2 players in that market?
Exactly. So you buy the ones who survive, and the ones who still make money. And they are not investing because they don't need to invest. There's overcapacity. So they give you a nice dividend. They do share buybacks. They will get through this, and they're not overly expensive. Even after sometimes a big rally, the share prices look like, wow, they've gone up. But if you look at it over the last, say, 5, 6, 7 years, they've come down so much. These valuations are still not stretched. So I think, you stick to the number 1, 2, or 3 in each of these markets.
I mean, if your thesis is correct and we're already past the apex, theoretically that means we can already see the number 1, 2, and 3. I mean, we don't have to name names.
But
it's fairly clear in some cases.
Yeah, exactly. But in certain industries, think about, for example, electric vehicles. Now, I'm not allowed to name names, but everybody knows that there's 1 or 2 companies that are exporting and actually gaining market share. So I think in certain industries, it's pretty obvious already.
Okay. Yeah. There's a viewer question here. I wonder if you could chime in this, right? So we talked about the amount of money coming through, 140 billion, roughly, US dollars year to date.
Yeah.
That's clearly mainland money coming here to buy this market. So where are the foreigners? Or is this simply just a mainland play, for example?
So what we've seen with the foreign funds is that the Asia-Pacific funds, they were at the beginning of this year small underweight. Worried that, hey, if China rallies, I need to at least be ready. And we've seen them moving overweight. But the global funds haven't really moved that much yet. So they can really come buy in here. So most of the buying, actually, you're right, has come from through southbound. It's Chinese investors have said, we want to allocate more money, and they wanted to buy these internet names, and they're listed here. So southbound has been a key driver. I think regional funds have been the driver, but the global funds, they still need to come.
We know you're overweight. Final quick question for you. Hang Seng Index is at 23.3. Your year-end target's at 23.8, if I'm not mistaken.
Yeah, that's right. So very close.
We're there. So how are you thinking about? Are you about to revise that higher sooner, or?
I think there's simply upside risk here. If profitability improves, if the liquidity situation improves, if bond yields come down and the dollar is weakening, all of that is happening, and we see more confidence in growth coming through, that's right. And our index targets, as you could say, is sort of, without being too technical, sort of different probabilities and different scenarios that you then attach. But these scenarios are shifting towards becoming a little bit, more bluer sky, I would say, less cloudy. So, there's clearly upside risk. Yeah.
Herald van der Linde, thank you so much.
Thank you.
Head of Asia Pacific Equity Strategy there at HSBC. Yeah, and the plug as well there. The Global Investment Conference of HSBC is in 15 days. There we go. Hang Seng Index down 2%. A preview of the Open is coming up next. This is Bloomberg. Good morning. Okay, so if you're still in bed and you're looking to come into the market, call in sick. It's one of those days, and then we'll revisit this tomorrow. It's looking like today is going to be an extension of the global sell-off that we had overnight. In a moment, we'll talk more about this wall of money coming through and maybe how that possibly offsets the drop today. Buy the dip? That's a question. The Open is next. This is the China Show.
Good morning and welcome back. You're watching The China Show. We are counting down to the open of markets, 40 seconds or so away. And really, it's a story about what has happened overnight in the US, where it's already spilling over into sentiment when it comes to Asia stocks. We're really looking to see how that expresses itself today in Chinese markets and Hong Kong markets. But there is this big counter-narrative, this big counter-force, Dave, and that is, of course, southbound flows, $3.8 billion that came across the border into Hong Kong yesterday, despite the sort of 3-day, falls that we've had in Hong Kong indexes. Yeah,
maybe because of that too.
Yeah.
Right. We tend to get we see a pickup in those flows, particularly during bad days, particularly during afternoon bad days, right? And we'll see whether or not that saves today. And certainly yesterday, to your point, maybe it did not. Wow, okay, that's not normally a loss we see at the open here. We're looking at 1% drop on the CSI 300. Shenzhen's down about 1.3%. Okay, so that's quite a sizable move lower in that benchmark. Some of the other moves we're tracking here, okay, let me just zoom in a little bit. Your 10-year yield is now at, okay, so at that level, we're actually right on the 100-day moving average, which is the ceiling we've been testing there on the yield story.
Yeah.
The look in Hong Kong is probably going to be worse than this. I haven't checked the latest numbers, but you'll see it in a moment there. Oh, yeah, that's bad. Okay, 2% on the Hang Seng Tech Index. The guys at HSBC just came on as well. Herald van der Linde, of course, nothing's changed for them. They went very early on, overweight in China. Nothing's changed for them as far as January goes, and they just laid out the case, really, why this market likely holds up better than others in a scenario that, of course, everything falls. But, yeah, they are still fairly bullish on this. Tencent, Baba, 3.7%. Is a drop in Alibaba. We'll talk about the Meituan story later on, but certainly there is this Deliveroo effect and this announcement, of course, of them closing down in Hong Kong. It might be because of their own bets into this market, making competition rather hefty. Let's put it that way. Okay, Bilibili was big drop overnight. We should see that play out, 4.4. Meitu is a crypto story, and the drop we have in Bitcoin below 80,000. Leapmotor was out with earnings. Slightly wider loss than expected, and Ningxia Baofeng is coming out with earnings today, just to get you through that. Okay, as we were talking about, right, southbound flows are the big counter-narrative, as Rebecca was pointing out early on. Nearly 30 billion net buying, that's Hong Kong dollars worth, through the Stock Connect yesterday. To talk us through the implications of this is Sang-Mi Cha, here with us in set, our Asia Stocks reporter. So, yeah, to tell us, why don't we start here and whether this likely will continue today?
Yeah, so the southbound trading has become ever more influential over the time. And just like you mentioned, we see more of this trend coming in when there is a dip because the mainland investors tend to buy the dip. And so we'll have to see whether they're going to do the same today. But it's surpassed the earlier level and it's hit a record with the $3.8 billion worth of Hong Kong stocks from mainland investors. And we're seeing this divergence between the HSCI, the Chinese stocks listed in Hong Kong and the onshore benchmark, because the CSI 300 is down 0.2% this year, whereas the HSCI is up about 20%. So that alone kind of explains how there's that boost in confidence and sentiment that from the mainland investors, their confidence in artificial intelligence, because a lot of these tech giants are listed in Hong Kong, like Alibaba, JD.com, and so on. So we're going to be seeing that divergence between these onshore and offshore benchmarks, and we'll be tracking how the southbound trading gets ever more powerful.
And there are these two narratives now that we're seeing particularly pronounced in markets today. The likes of Citi are coming out with a note saying, there's at least a pause in US exceptionalism. Their strategists downgraded US equities to neutral from overweight. China upgraded to overweight. To what extent is this sort of an abnormality, or do you think that this sort of trend is taking hold in markets?
Right. So it's quite of a significant move because Citi, in fact, has been overweight on U.S. stocks since October 2023. And so now them going neutral on U.S. equities and then now boosting the rankings for the Chinese equities to overweight, that's quite of a significant move over there. But we are talking to the traders and they see that when it comes to Chinese stocks, what it always meant, the catalyst was always like, what's the next meeting? So there was no stimulus blitz here, then there's nothing to worry about because we have 1 month later, we're going to have another meeting that's going to talk about stimulus. So all of that was centered on the next government meetings. But now the narrative has changed to a way that they have more fundamental to look at. They have the private sector driven rally now. Xi meeting with Jack Ma, that symposium was that game changer, a lot of the market watchers say. And so we're seeing a lot of these earnings, better earnings for these tech stocks as well. So that Chinese equities are becoming more normalized in a sense that it's not just stimulus driven only, but it's actually driven by the company's fundamentals.
Yeah, it's this time of the year, funnily enough, where investors are attuned to things taking place in Beijing and not so much the markets. What's different this time is you have the two sessions. I think it concludes today, right? and the markets are doing well. Give us some context here. It's been a while since we've seen a dynamic like this.
Yeah, so we had a story for the first day of trading after the National People's Congress. Usually it was like down days most of the times, but we saw that this time around it was a good day, and we're trying to see how the NPC has done during these times. It usually goes on for a week, and then maybe some days some of the years it's been 10 days or so. But so during that time, we've seen not so much moves in the past 7 years or so. It was mixed, and even if it was up, it was about like 1 point something % up. But today we're going to see, as of yesterday, as I checked, it was about 4.1% up or so on during this time of the 2 sessions. So we're going to see today, after the market close, whether it's been a positive impact on the MSCI China Index.
Okay. Well, on that note, first we will thank you, and we will get back to your desk to check out what the rest of the day will hold. Sang-Li Cha there and her team, of course, fantastic coverage of these markets. They're going to be very, very busy today. Right. Speaking of very busy, we're looking at U.S. futures as an update. I'm sure you guys are very curious how we're doing right now. So on the S&P contract, we're now down 0.7%. I just did some rough math. That now takes at 55.84. We're now 9.5% down from the peak, so we're very close now to entering a technical correction on SPX. The damage across equity markets here, 2%. A glance at very quickly across the currency markets, dollar yen, I think the euro is coming up as well, and of course dollar China is coming up. There you go, 725.94. That's at about the 100-day moving average to the upside. That should be, of course, a limit, and we'll see whether that provides the support, of course, to the opposite there. But yeah, that takes really back to China here. Yeah,
it is interesting to sort of note this dynamic that it's Beijing that seems to be sort of taking the tariffs in their stride. Yeah. And in fact, now we have US markets with this very strong reaction, trying to kind of digest, okay, what happens? We're going to be entering this period of uncertainty with tariffs. But anyway, as you say, it does take us to the China story. China has set this fiscal deficit target of around 4% of GDP to counter the effects of rising US tariffs. We spoke with Michael Pettis, Senior Associate at the Carnegie Endowment for International Peace, on what's next for the Chinese economy.
Raising the fiscal deficit target by a percentage point is more for signaling purposes than anything else, because the truth is the real fiscal deficit, as calculated, for example, by the IMF, is something like 15 to 20%. It's much higher. So what that really means is that part of the fiscal deficit will be shifted away from the local governments towards the central government. But ultimately, it doesn't really tell us a lot about what they're going to do. I think this year will look a lot like last year. The really big question mark is trade. Last year, trade was great. If it's good again this year, it'll look very, very similar. If it's not good, and they're not able to raise consumption, which is their big goal, then we'll probably see a bigger fiscal deficit. We'll probably see more debt and more investment in infrastructure.
Well, what is the panacea for creating that domestic demand?
I think it's pretty simple. Budget constraints. I mean, you basically spend based on your income. If I want you to spend more, I've got to give you a bigger income. So if you raise the income share of ordinary Chinese, the consumption share will automatically go up.
Is that going to happen, though?
It's really tough for it to happen because a lot of people think that low income is just sort of an oversight or a bug in the system. But the low household share of GDP is fundamental to the way the economic model works. And it's the reason why Chinese manufacturing is so competitive. So if you fix one, you undermine the other. You can't really separate them.
From a historical standpoint, how do you see the evolution of protectionism coming on both sides? Obviously, from the trade front with the Donald Trump administration, now 20% tariffs on top of what was already in place. It's a symptom of something you told me much deeper and longer lasting.
We see it too much sort of as a Trump-Xi thing. And I don't think it's that. I think, we're going to see it continue to spread. The imbalances that we have are the largest we've ever seen. As Keynes explained, these imbalances put downward pressure on global demand. And the countries that absorb that downward pressure have to respond either with higher unemployment or much more likely higher debt. And at some point, it's not sustainable, and you've got to reverse it. So we're going through, in my opinion, a major transformation, equivalent a bit to what happened in the 1970s or what happened in the 1930s, a big change in the way the world operates. Trade war is particularly painful for surplus countries. Remember, the biggest surplus country then was the United States, and it suffered most from the contraction in global trade. If you can't run surpluses and you can't raise the domestic demand, then you have to reduce production, which means firing workers, rising unemployment.
Where do you think we'll be in 5 years with the Chinese economy? Essentially, it's going to be going through a protracted trade war, and they have to also stimulate domestic demand. So where are we going to be in 5 years?
That's as much a political question as anything else. Growth will be much lower. I think growth expectations will also be much lower. Debt levels will be much higher, which is one of the reasons they'll have to constrain the growth in debt. But the real issue for me is whether they decide to go through a rapid adjustment, which means taking the losses and allocating them, or a slow adjustment. If I had to guess, I would say they would prefer a slow adjustment because it's socially less destabilizing.
Yeah, there we go. That was Stephen Engel, of course, then the Carnegie Endowment for International Peace Senior Associate Professor of Finance at Peking University, Michael Pettis, there in Beijing. Right, we got plenty more ahead here on the shows, particularly an update of this, there we go, this bleed we're seeing across risk assets. That said, we're coming off lows of the day. We'll see if this continues. This is Bloomberg. Welcome back. Let's an update of these markets. Let's have a look at shares of Alibaba. There we go, 2.6% to the downside. I think we were down about 3.5 overnight. Let's talk more about the company, the business, part of the business at least here. So our tech reporter, Annabelle Jewelers, had this exclusive interview with Alibaba.com, the first business, of course, of the group. And Belle is here to talk us through the highlights of that conversation you had.
Yeah, well, so just to give some context here, so Alibaba.com is the wholesale online division of the business.
The OG.
It is the OG, actually.
Yeah.
It was the first business of the Alibaba Group. It actually went live on March 10, so yesterday, 26 years ago. So it's been around for a while. But essentially, the business is dealing a lot with Chinese merchants. I mean, they've got around 200,000 that are on their platform, but they've got merchants from other countries as well. India, for instance, Pakistan, those were highlighted. But essentially, it's looking at ways that it can continue to grow that, even as it faces a lot of these trade challenges, you know, with the risk of tariffs. They're using AI to do that, and even though we think about AI and we think about AI at Alibaba and Alibaba Cloud, for instance, and what they're doing with the QN portfolio of AI products, actually they have their own one called ASIO, which is sort of a sourcing platform that uses AI, but they see AI integration across around half of their businesses are on the platform. But take a listen to what he said about the expansion plans in the US in particular.
We see a lot of kind of growth from US since now we have global supplies in China, in Southeast Asia, in Europe as well. And we believe building a kind of global supplies with more resilient supply chain to help SMBs in Europe is still our strategy. And in the early of this year, we see the US orders, meaning the SMBs buying from Alibaba.com is still kind of 30% of growth. So I think it's very strong, and we'll keep investing on that.
Do you see that still being able to be replicated even if you've got a lot of trade uncertainties and tariffs that are rising?
I think so. So the first one is that we are providing a supply base all over the world. So now we have more than 10,000 of suppliers in Europe and also in Southeast Asia, in India and Pakistan as well. So we're not supplying the kind of product only in one country. Actually, it's a global supply. And the second is still demand and supply is the fundamental rules. So all the other kind of turbulence may impact in short term, but according to the current data, there are still a lot of people who is not penetrated by internet or digital we believe there are going to be more and more people is using the platform technology to do their business. So that is not my kind of concern now.
We had the inflation figures that came out and they showed that really there's a concern building still around deflation within China, both in CPI, PPI, but you're dealing with businesses that are export oriented. So how are those businesses looking right now?
I think two things that I can share with you. So since the beginning of this year, the search index, so both in China kind of search engine, also the social platforms. So searching Alibaba.com and global trading actually increased by 3 digits. It's like 118% of growth, which indicate that more and more people is interested to go global. And also the new sellers onboarded on Alibaba.com actually is growing very fast since last year. So we believe this still is a trend. And also one thing more that we can add to it is AI technology. So previously, many of the Taobao or Tmall suppliers, if you ask them, do you want to go global? I think the answer are all yes. But when they learn that they need to overcome the language, the time difference, the foreign exchange, custom clearance, all this stuff, then it's a little bit hesitant. So now all these layers is kind of is built on top of the new technology. And now we are lower the barrier for everyone to do this business. I think this is another angle that we impact and improve the kind of confidence for the suppliers.
So you heard there that Kuo Zhang is still really optimistic on the outlook for this business, even with these rising geopolitical tensions. And again, as I said, a large part of this conversation really was around the AI portion of the business, how they're using that to also encourage more companies and allow them to expand further afield.
Okay. Annabelle Drew is our tech reporter there. Thank you so much for joining us. And if you're a Bloomberg subscriber, you can catch up with all of our interviews using our interactive function TV Go. You can also join the conversation by sending instant messages to our team and our guests, which they have been doing so far today, Dave.
They have. Thank you so much.
During our live shows. Please do go check it out at TV Go. There's plenty more ahead. Stay with us. You're watching The China Show.
I think it's going to be panic at the disco. We haven't gotten there yet, but as these levels climb, there will be unwinds and more uncertainty that triggers even more.
It looks like those conditions are not going to change and the volatility is going to persist as long as we have uncertainty around tariffs and economic policy. But I do believe that longer-term investors can start looking at these levels, start putting their shopping lists together, and start looking at quality names that have been beaten up over the last couple of weeks.
It's the whipsaw that's going on that's driving the markets crazy.
Right. Just some of our guests, they're chiming in on really what's taking place call it capitulation, really, that took place overnight. In fact, when you look at what's happening in futures in the Asia-Pacific this Tuesday, we are continuing to see, albeit, of course, not to the same extent, still some weakness coming through here. Although I'll caveat that in the last few minutes or so, we've come off lows just a little bit. But yeah, even despite that, we're still down 1% on NASDAQ futures. So case in point, just to take a step back, right? So NASDAQ, we know tech has entered, well, in the NASDAQ case, it's entered a correction. The Russell 2000, I believe, is down over 20%, if not close to that. The semiconductor index, rather, to correct myself, is down over 20% from the peak. S&P 500, with the losses right now, is about a bad day away from entering a technical correction there at 55.89 measured from the peak. Right. Let's have a look, please, at some of these battery makers in China. And, we talked about this story early on and some of the potential restrictions, Rebecca, that they might be facing here because of geopolitics.
Yeah, essentially a bill passed in the House that would ban the Department of Homeland Security from buying batteries from 6 different companies linked to the Chinese Communist Party. It's, of course, about this broader shift to try and combat the influence of the CCP as the US perceive it in America.
Yeah, so we'll continue to track this, and I think there is, I guess, in some ways, when you look at the calendar of events ahead, so April 1 or 2, of course, that's when that review concludes, and that's the next sort of hurdle where we could see, I guess, something different as far as the tariffs goes, as far as the U.S. goes. And then, but you have all this reporting taking place about the initial coming together of the two presidents, which might provide at least some light at the end of the tunnel here if traders are concerned about geopolitics.
Yeah, I mean, it's been really long awaited. We think about in the first few days of the Trump administration, there were reports that, we could have a call at any moment. And we were sort of expecting that because, of course, Trudeau spoke to Trump and so on, right? So we were kind of thinking that could come any day. Now, one report saying it could be in April next month. Another, the Wall Street Journal, reporting that we could see this sort of joint birthday celebration between Xi. His birthday is June 15th. Trump is the day before that, so perhaps a more sort of convivial. Does sound sort of something that's potentially quite appealing in terms of what you're talking about, the sort of idea of good spirits or setting a different tone to the relationship.
June 15 and 16, I believe, are those dates, the birthdays, right? Yeah. That's a side note, of course, but certainly into the birthday conversation there. Right, we're down about 1% on the Hang Seng. We're down 0.5%. So we have come off lows of the day. In a moment, we'll get you guys an update here of the southbound flows coming through as well. We're just amalgamating some of the data coming through. Very quickly, with the losses we've seen so far, it's been a bad year to be a billionaire. 226 billion so far has been wiped out of the combined net worth of the top 20 billionaires in the U.S. so far year to date. And you understand with the equity route we're seeing, that is somewhat, I guess, expected. Really, I guess stopping short of saying we're probably not going to see a GoFundMe page here. Anyway, global macro movers for you, the damage across your markets. More in a moment here. This is the China Show. Welcome back. You're watching the China Show. Man, these markets are moving. And there is some added layer here of, further developments taking place because as you can see visually, the Hang Seng Index gapped lower and first 30 minutes of trade, as you can see, has really come off lows of the day. The Hang Seng Tech Index at one point was down over 2%. At one point, in fact, just a few seconds ago, was at about the zero line, so completely erased the losses, and we've since pulled back a little bit right now. Down about 20 points. Okay, so the counteroffensive we were talking about earlier on was these flows coming through out of the mainland.
Record $3.8 billion that came through on Monday, and you made a very good point right at the beginning of the show, which was, buy the dip, question mark. It does look like that's happening.
It is. In fact, right now, so we had, I think, 3.8 billion, about just under 30 billion Hong Kong dollars. This one right now, so the chart you're looking at on your screens actually tracks in real time the amount of money coming through net across the Stock Connect. So we're now at 4 billion for the day, and we've just hit the 30-minute mark for this. So you extrapolate, we have 2 hours in the morning, you have 3 more hours in the afternoon. So if this continues at this pace, we will take out that record yesterday. So this is really some hefty buying coming through here, Rebecca.
Yeah. I guess the broader discussion that we've also been having, though, is what does it take to see international markets coming back in and international investors coming back in here? We've really still seen a lot of hesitancy, and we haven't necessarily, even with all this deep-seek optimism, I think buyers, mainland buyers, made up about a quarter of the average daily turnover last month. We're still seeing them really dominate and driving momentum. When does that start to spill over elsewhere? And when do we start seeing that real rotation out of other parts of the world into China? Yeah, the long-only funds, this really is a good indication of the types of strategies that are working so far. So tactical trades, not so much maybe passive, not so much maybe active managers as well. An update really of tech and your big ones as well. The note out of Citi is actually blowing up. They're cutting U.S. stocks. So overall, they're neutral on global equities. They've raised China. They've reduced the U.S. on this pause, the bank says, in U.S. exceptionalism. In fact, when you have a look at that right now, the iteration of these markets, so we've had a look at China, an update of U.S. markets very, very quickly. I think we're still down about 2% on the benchmark itself in the region, 1.6%. U.S. futures, S&P's down 0.6%. NASDAQ's down 1%. VIX futures, top row, rightmost side, up to 26.
as we speak. That row also shows you the damage across equity markets in the region. Although in the FX markets, we are seeing a reversal of the dollar strength yesterday. So as you can see, well, with the exception, I guess, of several currencies. But the euro is on the front foot yet again. We're stronger by 0.2%. Let's bring in Mark Cranfields out of Singapore, our MLive strategist. Mark, you guys put out the perfect, I think, question of the day for our viewers. Will investors be buying this dip? Why don't you chime in on the context there?
Not here. I think it was particularly aimed towards the US markets, and if you look at what's happening, particularly with the Nasdaq, it's a really brutal sell-off which is going on there. And if you look at the performance that we saw last year, the times when it had its significant dips, one that finished in September, one in August. It suggests that we've got quite a way to go. Don't forget, we're into the final stages of the first quarter of the year. So if you're an equity trader in the US in particular, it's not a very good start to the year at all. Markets are well down from the beginning of the year. Now you're fighting to save what little P&L you may have left. It's unlikely you're going to find many very brave investors, particularly in the United States, who are going to put big money into the dips here. There might be bits and pieces, and people with a longer-term view may be nibbling, but you're not going to see anything. It's very unlikely you will see anything serious turn around before the end of this quarter. Other parts of the world, people might be a little bit more committed. You were chatting there about China, of course. There's been some thoughts of a decoupling theme, that there's enough in the DeepSeek-related AI story in China that may attract, and it obviously is attracting big money. You can look at those southbound flows. They're still very significant. So clearly there is some very big portfolio flows going into China, Hong Kong. But once in this kind of environment that we have now, sentiment for today and yesterday is so negative, it's unlikely that even Hong Kong and China can get away with it. Once things settle down a little bit, yes, then people will reevaluate. They'll see where the stronger stories are and where it makes sense. But in the very short term, it's very hard for Hong Kong and China to shrug this off when you've got it's like a juggernaut. It's crushing you from the US markets, and people just want to get out of the way for now.
Okay, Mark. The BOJ. We have a meeting next week. What are investors pricing in? We did have comments from a former official saying next rate hike could be somewhere in the middle of the year, around about June.
Most exciting event of the week next week. Yeah, we love BOJ days. It's probably going to be a hawkish hold. Nobody's expecting them to change interest rates next week, and that's all the signals which have been given off. But clearly, they've also been suggesting that they're still got more work to do. Things are falling into place. Wages are going up as expected. The data is supporting that. We've just had the latest Rinban suggestions. The big unions are looking for even bigger wage hikes this year, after 2 years of very large increases anyway. That's all feeding into the inflation story in Japan. It's becoming sticky. Food inflation in Japan is still very high. If people even have to go into the rice reserve, Japan's had to open up that because rice prices are so high there. That's affecting ordinary people as well. The conditions are all falling into place for the Bank of Japan to do more. It's very rare for them to do back-to-back rate hikes, so that means that next week is almost certainly not. But the May meeting is going to become a live one. That's the expectations that people have, because they don't want to wait too long. They've got everything is falling into place in terms of the data. So you would expect, particularly in the press conference, you would expect Governor Ueda to give signals that he's preparing the market to make the next meeting quite possible for a rate hike. If there's no disasters elsewhere, if the rest of the world isn't crumbling, then Japan is very likely to raise interest rates again before the middle of the year.
Mark, our good friend Craig Chan is waiting, head of global FX strategy at Nomura, coming next right after you. Let's set the stage for that conversation. I'm reading this post from Anna Wong out of Bloomberg Economics on X. The R word is back, not Rebecca, recession here, but not to the extent of the number or frequency of mentions that we had last year. How should we be thinking about a U.S. slowdown from this point, and how should we be pricing that in?
Well, it very much feeds into the Fed story. I mean, what does it mean in terms of the Fed getting back into rate-cutting mode? You heard from Jerome Powell last week, and he was still going with the same mood that he's happy for now, as they are. Other Fed people have been saying that they seem to be comfortable with the pause as well. But you can see that traders are pricing for at least 3 rate cuts before the end of this year. There's going to become a tipping point. It's not too far away. If the unemployment rate in the United States starts to pick up towards 4.5, maybe even towards 5% by the middle of the year, the pressure on the Fed will become very big. They will probably have to give in to some extent. The political pressure will come down on them as well. Plus, the numbers themselves will be telling them that a big part of the equation, the job side, is weakening, and they may need to respond. That is what people will be thinking about. Whether we actually get a recession or not doesn't matter in a sense. It's where the direction of the Fed go towards it. Traders believing that the Fed will need to respond, and they'll need to respond fairly quickly.
Mark, thank you. Mark Cranfield, out of our MLive team in Singapore for us. Let's bring in Craig Chan, as we were pointing out there, the head of Global FX Strategy at Nomura, joining us right now. Craig, a pleasure to have you on the show. Good morning. It's been a while since we last spoke. Why don't we start off with just the Fed conversation here? The U.S. 2-year yield, I think, was up 85 basis points from, I think, September to the recent peak. We're down 50 basis points. How are you guys thinking about market pricing around the Fed this year?
Yeah, I mean, look, Nomura's view right now is still that the Fed will not actually cut rates this year. But I would say that clearly there is a bit of caution around some of the soft data in the U.S., which has slowed quite significantly. There are offsets for some of the data, but I would say it's not that clear that, there are kind of idiosyncratic factors on why the data has softened. I would just say that over the coming weeks, we're going to continue to observe this softness in the soft data and, of course, the hard data before making further judgment. But the market is moving. It is beginning to price in more potential cuts from the Fed. I would just say one thing. If the soft data continues to soften and some of the hard data, like the, say, employment data, begins to weaken, then there is certainly the risk that the market will price in not just the potential for 3 cuts from the Fed, but actually even possibly deeper cuts from the Fed.
Craig, I want to just take a step back even further. Do you see that we are now at the beginning of a phase at the end of US exceptionalism where Europe becomes the driver of global growth? And if so, how do you trade that? What's your best trade in that context?
Yeah, I mean, look, there are a lot of factors that are kind of adding up together. I think last week we could have seen the trigger for a bigger kind of mindset towards the end of, or at least the fading of US exceptionalism. That could have come from the non-farm payrolls report, but it didn't. But I would just say that for sure some of the economic policies that are coming out from the US is creating significant uncertainty around the US and the world. It's also about the softer data that has been emerging in the US, particularly soft data. As I said, key is the hard data ahead. But, it's about, as many of your speakers have talked about, it's about valuations of US equities, this rotation that's happening out of the US into other global equity markets. That's another theme that's building. So for sure, there is questions on the US exceptionalism. The cyclical downturn doesn't help. I would say the risk ahead is actually, if we do see more signs of the cycle slowing in the US, people will start actually raising concerns about the structural weakness of some of, if you want to say, the factors that could lead to the dollar weakening even more. Twin deficits, currency overvaluation, diversification. These are things that will rise in the mindset of investors if we start seeing the cycle slow down more in the US. So how to trade this? The way we are looking at this in Nomura is that we are emphasizing quite strongly to actually be long euros against either Swissy, sterling, or even Thai baht. We'd also say that we are looking at some bias towards risk and negativity globally, particularly led by the US, which means we want to be long yen, and long yen particularly against sterling and also against the Korean won. These are some of the top recommendations we have had actually for a few weeks now.
Craig, I was going to ask you about the renminbi, but maybe we can save that for the next question. But ahead of that, since you mentioned the yen, next week's the BOJ. What language are you looking for that might tell us what they're about to do? And I guess connected to the BOJ question is, looking at data on positioning, for example, is there any indication that we might see a sort of a repeat of last year's carry unwind in the event they tilt more hawkish than usual?
Yeah, I mean, it's an interesting point. I would say for the BOJ, we are not expecting anything to come out of next week in terms of, policy shift. But the tone may be a little bit on the hawkish side. I think that's generally the consensus. But even before then, I think what's going to be very important is actually at the end of this week, where you'll have the first round wage negotiation at Wrangel. Now, I would simply say if we have something around 5.8% or above on the wage negotiation, market will take that as a pretty strong signal that the BOJ actually may be hiking at the following meeting, possibly around the kind of May period. So yes, for sure, I would think that, next week is nothing, but it's about the tone and it's going to be about the underlying data in Japan.
Craig, just to bring in the China question too, and I know you have some calls here on the currency, the growing pressure to depreciation pressure in the currency. So far, that's largely not happened. The impossible trinity, something's going to give. They haven't cut rates, perhaps. Reason why we're seeing the long end yields right now, the short end yields have picked up. The long end's now, in fact, as we were just talking, Craig, just to mention, the 30-year yield has now crossed the 2% handle. How do you trade the renminbi right now?
Yeah. So we are, and we have been recommending to be short CNH against a smaller bridge basket, something that's similar to the CFES basket. This trade will take onto a few things. One is the softer dollar backdrop, where we believe softer dollar will mean that the move down in dollar China will be somewhat limited because we continue to expect the capital flow backdrop to be a little bit challenging. Even all this discussion about, the AI theme in China, the fact is that the money has actually been primarily moving into Hong Kong from China. That this has been a pretty consistent theme in terms of the kind of portfolio, if you want to say rebalancing because of the AI theme. Obviously, that could change ahead when there's real investment that goes into China, but for the time being, this is going to be a challenge. So I think that this is going to be the way in which we're thinking on trading renminbi over the coming weeks with this kind of softer dollar backdrop. The issue is in April, if we get another round of tariffs to come through from the Trump administration, we've had 20% already since he started his term. Question is, do we get another round? And I think the risk is actually quite high. I mean, our view in Nomura is that we'll see an additional 15% on China. If this emerges in April, there really is that question about how willing China is going to be to hold the exchange rate stable, because that willingness clearly has been there with this first two rounds of 10%, somewhat, supported by the softer dollar. But of course, as we go into April, 15%, I would say dollar China risks breaking higher on that. Even in a softer dollar backdrop, I could see dollar China on 15% additional tariff from here going to like maybe the 750 kind of region.
Okay, Craig Chan, thank you so much for joining us this morning, Head of Global FX Strategy at Nomura there. And still ahead on the China show, as the MPC wraps up in Beijing, Moody's ratings will be giving us their reaction to China's economic targets amid all of those trade tensions with the US. You're watching the China show. This is Bloomberg. Good morning, you're watching The China Show. Now, the head of the Alibaba Group's original core business says the use of various AI applications are having a profound impact on the company. Alibaba.com's president, Kuo Zhang, tells Bloomberg exclusively that its vendors are having an easier time finding new markets for their goods.
Take the buyer as an example. So if we think about the search volume for the information or for a product, I think the search volume for the information part is 10 times than the products part. So think about it. If you want to start a business, you will not specifically go to a products or go to a kind of suppliers. You will come up with an idea like what's trending and what's the specific kind of textile you're going to use in your product. And then it's come up the big business plan, and then it's come to the products. So now using AI, I have this kind of a multi-round dialogue kind of search. A lot of people now, it's more easy to do business online. And for the sellers, we see current our kind of for agent, these tools is already better than 60 or 70% of the seller if they are new on Alibaba.com in terms of the conversion rate for the customer engagement and for the product management.
But how many businesses, I think there's around 200,000 SMEs that are on the platform. How many businesses are actually using AI today?
So currently the weekly active sellers are more than 100,000. So it's more than half of the sellers is already equipped by this agent-based tools. And for the buyer side, actually, we launched the Axio from last November. Until now, there are accumulating more than 1 million users is using Axio, using this AI-based powered search.
How much do you feel the competitive pressure on AI, given the amount of innovation that's coming from China?
Okay. So first of all, we think there's a lot we can do so far. For example, we talk about the reasoning models, but based on language. There's a lot on the multimodal stuff that we can do later on. Like you can base on anything, an image, a video, or a file that you uploaded the file that the reasoning model can help you to interpret and to execute upon. So all those kind of things, we still believe there's a huge space to grow, and we can leverage the most. I mean, the models from Meta, from DeepSeek, from Ali Cloud, Tongyi Qianwen. So all these models actually can help us to boost the capability of the applications that we believe application actually is a key here. And why we think we can do it here, we can do better than others, is not going to be a few tools that play for the people answer the easy questions. It need to be highly integrated into the big scenarios. Like global trade is a $30 trillion business. I don't think of any other business is larger than this. So if we can apply AI in this business and helping a lot of SMBs, so who cannot participate in the global trade, but now they can. So I think this is a big success for us.
A lot of people are expecting industry consolidation or AI consolidation in China this coming year. How many winners do you see in the AI space in China?
So actually, for that part, I can only speak of my opinion. So if you ask this question in January 2025, I think nobody can anticipate that there's a company called DeepSeek. I think you ask this question in March, I don't think that anybody can anticipate what's going to happen in April as well. This industry is moving so fast, and a lot of people doing a lot of innovations. We just need to focus on what are the right problems we need to tackle. As people in this technology domain, I don't think anybody can anticipate what's going on for this year.
Yeah, and that was Kuo Zhang, the president of Alibaba.com, speaking exclusively with our tech reporter, Annabelle Trulers. Plenty more ahead. This is a China Show.
Good morning. You're watching The China Show, and here are some of the major global stories that we're following today. Elon Musk has blamed what he calls a massive cyber attack for widespread disruptions on his platform X. Musk claims the move was orchestrated by a large coordinated group or country. Tens of thousands of users globally reported intermittent outages on the app, with new posts failing to load for users. Dark Storm, a pro-Palestinian so-called hacktivist group, took credit for the attack via its Telegram page without providing proof. The US has passed a measure to restrict the procurement of batteries from 6 companies linked to China. The legislation is part of a broader effort to scrutinize domestic reliance on Chinese companies seen as a threat to US interests. The measure now moves to the Senate, where it's expected to attract bipartisan support.
All right, let's have a look at these markets very, very quickly. I just have a limited amount of time. Let's start things off with these battery makers. Nothing much in terms of market reaction. Of course, there's a House bill overnight that's effectively facing some restrictions, particularly if they are tied or deemed to be tied, let's put it that way here, to the political situation here. Crypto's down because crypto is down. That's very, very simple. And just some updates here coming through out of the Philippines with the central bank governor talking about how there are several rate cuts on the table. A hard landing is unlikely for the year. They might consider a move of 50 if there is a hard landing, but he said just now. And they've moved their meeting to April 10 from April the 3rd. Welcome back. Just going into the Japanese lunch break right now. And yeah, I mean, these markets could use a break following what we've seen so far. We're down about 2% on the Topics Index, which really is unsurprising given the drop we've seen across global risk assets, although it's certainly worth pointing out, and the BOJ is next week, by the way, it's worth pointing out that equities are coming off lows of the day. In fact, this next board is about to show you that on a regional basis. And I can even tell you for the Topics Index, we were down over 2% on that. We are now down 2%. So S&P futures are now, wow, as I speak, now closing in on zero from being down as much as 0.8%, I believe. Asia was down over 2%. Some of these markets here in Greater China, in fact, were positive at one point. But broadly speaking, it's going to take, I guess, maybe a few hours for the evil to get shaken out or scared out of this market. As you can see, most sectors are still lower for the day. And the dollar, which was weaker, has now flipped back into, at least Asian dollar index, right, my mistake, is now slightly on the stronger side of things.
All right, and shifting gears, taking a closer look at China here, we have seen Beijing setting this fiscal deficit target of around 4% of GDP to counter the effects of rising US tariffs. We spoke with Michael Pettis, Senior Associate at the Carnegie Endowment for International Peace, on what's next for the Chinese economy.
Raising the fiscal deficit target by a percentage point is more for signaling purposes than anything else, because the truth is the real fiscal deficit, as calculated, for example, by the IMF, is something like 15 to 20%. It's much higher. So what that really means is that part of the fiscal deficit will be shifted away from the local governments towards the central government. But ultimately, it doesn't really tell us a lot about what they're going to do. I think this year will look a lot like last year. The really big question mark is trade. Last year, trade was great. If it's good again this year, it'll look very, very similar. If it's not good, and they're not able to raise consumption, which is their big goal, then we'll probably see a bigger fiscal deficit. We'll probably see more debt and more investment in infrastructure.
Well, what is the panacea for creating that domestic demand?
I think it's pretty simple. Budget constraints. I mean, you basically spend based on your income. If I want you to spend more, I've got to give you a bigger income. So if you raise the income share of ordinary Chinese, the consumption share will automatically go up.
Is that going to happen, though?
It's really tough for it to happen because a lot of people think that low income is just sort of an oversight or a bug in the system. But the low household share of GDP is fundamental to the way the economic model works. And it's the reason why Chinese manufacturing is so competitive. So if you fix one, you undermine the other. You can't really separate them.
From a historical standpoint, how do you see the evolution of protectionism coming on both sides? Obviously, from the trade front with the Donald Trump administration, now 20% tariffs on top of what was already in place. It's a symptom of something you told me much deeper and longer lasting.
We see it too much sort of as a Trump Xi thing, and I don't think it's that. I think, we're going to see it continue to spread. The imbalances that we have are the largest we've ever seen. As Keynes explained, these imbalances put downward pressure on global demand, and the countries that absorb that downward pressure have to respond either with higher unemployment or, much more likely, higher debt. And at some point, it's not sustainable, and you've got to reverse it. So we're going through, in my opinion, a major transformation, equivalent a bit to what happened in the 1970s or what happened in the 1930s, a big change in the way the world operates. Trade war is particularly painful for surplus countries. Remember, the biggest surplus country then was the United States, and it suffered most from the contraction in global trade. If you can't run surpluses and you can't raise the domestic demand, then you have to reduce production, which means firing workers, rising unemployment.
Where do you think we'll be in 5 years with the Chinese economy? Essentially, it's going to be going through a protracted trade war, and they have to also stimulate domestic demand. So where are we going to be in 5 years?
That's as much a political question as anything else. Growth will be much lower. I think growth expectations will also be much lower. Debt levels will be much higher, which is one of the reasons they'll have to constrain the growth in debt. But the real issue for me is whether they decide to go through a rapid adjustment, which means taking the losses and allocating them, or a slow adjustment. If I had to guess, I would say they would prefer a slow adjustment because it's socially less destabilizing.
Yeah, there we go. That was Stephen Engel and, of course, Michael Pettis discussing all things economics and politics, and certainly that greater intersection as it pertains to the Chinese context there, particularly as we wrap up what's really been an eventful 2 sessions in Beijing. On that, let's bring in Lillian Li, Vice President and Senior Credit Officer at Moody's Ratings, to talk us through her highlights from the political and economic exercise that's just wrapping up today in Beijing. Lillian, good morning and nice to see you. Yeah, why don't you take us through your highlights?
Good morning, everyone. So highlights, apparently the first highlight is that growth is now the top priority, policy priorities from the government, central government. That suggests it's reflected by a very ambitious growth target, as well as CPI target. But that suggests the government really want to do something to boost the confidence, the sentiment, as well as showing us a larger fiscal support from that point of view. I see Michael's point on the deficit plus the government bonds. So that's the first highlight. And the second is on the POE's role. It's apparently before 2 sessions, it has largely encouraged the POEs in different conferences, etc. And on 2 sessions, the same. So POE's role, participation in some national strategic sectors, infrastructure sectors, plus those AI-related high-tech sectors are likely to increase in future, supported by bank loan and other policies going forward. And then the sector-wise, we see, as I mentioned, high-tech sectors, green sectors, service sectors are likely to be the key bright spots that we should watch on for in the short term. So that's basically the highlights from the policy point of view. So where are the growth and what are going to support that, as well as the sectors.
Lillian, I want to pick up on your point there about this emphasis on private sectors as well as some of those bright spot sectors that you highlighted. What does this mean for corporate credit? And when do you think we actually start to see some of this monetary easing that might actually, improve financing conditions for these firms?
Sure, yeah. So about POE's role, we know that there was a crackdown on some of the sectors years ago, and 2 sessions before, we see that President Xi actually attended one of the important private sectors conferences that shows very strong support to POEs. And these, as I mentioned, POEs are likely to participate in more like those sectors SOE dominated before, for example, that railways, new power, or nuclear power, so water convergencies, as well as some of the infrastructure sectors. And then, other than that, the new sectors, including AI, robot, etc., these sectors already have a lot of POEs playing in it. But we are likely to see some of them have, sector consolidations, for example, EV. Some of them might see a stronger policy or funding support from the government, and those are the new emerging sectors. So I think POEs are going to see a brighter outlook pictures than before. And in terms of the credit, these are all credit benefits toward those POEs. But of course, on the funding support side, on our banking sectors, we do see that a higher participation of bank loans, bank lending toward these new sectors, most of them are POE participated, are likely to see higher asset risk. So that is one aspect of risk that we would like to see probably being afforded by the banking sector. Yeah.
Right. Now, what does this mean for, it seems we're past peak pessimism, number one, and it seems that, to your point, markets will need to remove further risk premia, let's put it that way, across both equity markets. We've seen that with DeepSeek and the other things, and maybe also credit. What does this mean for the risk profile right now moving forward of corporate China?
Yeah. Overall, the corporate China, Moody's view, we put China's non-financial corporate outlook as stable this year from negative, change from negative last year. So that's basically driven by the first property sector itself. It's we still expect the sales growth the sales will decline this year, but at a narrowing space. On the other hand, we see LGFV parts, the risk is declining as well, thanks to the debt swap, other things. And then on the new sectors, as I pointed out, those high tech or service and logistic, these related sector, we actually already we expect the revenue growth as well as profitability to improve from last year, and then their leverage ratio are likely to be stabilized. So that's the key main factors that support the overall non-financial corporate sector's stable outlook for this year.
Lillian, we've seen authorities express some concern and some anxieties about capital flight from companies, including increased scrutinies of firms that, for example, are thinking about raising funds to expand their operations overseas, in part to get around sort of some of the tariff constrictions. To what extent is this trend impacting corporate credit? To what extent is it impacting fundraising? How should we be thinking about this through this year?
Yeah, I think from credit point of view, think about why they are doing so, right? To bypass those tariffs and restrictions. And then, started from years ago, they are doing so, moving their productions and setting up other bases in outside of regions, outside of China, so APAC. So that leads to capital outflow or an investment being built outside of China. So from that point of view, yes, it's diversifying supply chain production base that actually give the credit to these companies. So that's why we see that the current tariffs on China, 20% or 10% on Chinese companies, are moderate. That's because exactly for those highly moderate, highly exposed sectors like machinery and electronics, we think their credit impact from these tariffs are limited or moderate. That's because they have diversified the production base. So going forward, this trend might continue. From my point of view, it's because of the trade environments are so uncertain, and there's a high possibility to see an ongoing tariff and other conditions getting worsened throughout this year. So this trend might continue, but that probably will not give too much credit. Affect the credit in a negative way, comparing to the benefits they may come, they may bring to these corporates in the medium or longer term role.
Lillian, this might be anecdotal, but I think it's a good window into how the mood has changed on the ground. I mean, you're in Shanghai. I'm not sure where the office of Moody's is. Is it in Lujia's way? But I want to get a sense of what the mood is like among the financial community there, given what seems to be we've turned the page really on this recovery story.
Sorry, can you rephrase your question?
What's the mood like among you and your peers there in the financial community in Shanghai?
Well, I think recently the sentiment actually changed a little bit. Changed actually not really to a bigger extent coming from last year, end of last year, since November's conferences. So we see that there are more supporting policies from all ends towards these private sectors, as well as financing conditions, monetary side, etc. So in terms of business sentiment after the Chinese New Year, we actually see the atmosphere is getting improved or better compared to a couple of months ago. So that's probably early signs of a pickup in the overall sentiment, but it's still a little bit too early to say that, given that these trade tariff things is still ongoing and evolving.
Yeah, they say, man manzhou. Lillian, thank you so much. Have a great day ahead there. Lillian Lee, their Vice President, Senior Credit Officer at Moody's Ratings. Just an update here of the CGB yield market. We've been tracking this very closely, and the pull-up we've seen. A 30-year yield, yes, you do see that correctly, now has a 2% handle on the yield there, and we now have a 1.9% handle on the Chinese 10-year yield. The opposite is taking place across U.S. assets. So you have U.S. futures coming off lows of the day, but as you can see, still quite a substantial drop in the curve right now. So we're down about 3.5 on the U.S. 10-year yield. Plenty more ahead. This is Bloomberg.
Good morning and welcome back to the China Show. Now, a story that actually did dominate trading room floors yesterday when the news was breaking. Deliveroo closing its Hong Kong business after weak sales and mounting competition weighed on the company. The London-based delivery firm said it will sell some assets to rival Foodpanda and close other assets. The app will remain active in Hong Kong until April 7th. Now, Bloomberg wealth reporter Diana Lee joins us in the studio. First of all, just tell me, what were you kind of hearing from your contacts and bankers? Because I did get quite a robust response, I would say, when this news broke. And what does it tell us about the changing landscape of food apps in Hong Kong?
Yeah, it's kind of a sad story. We see that Deliveroo always has this intense competition from its rivals. We have Foodpanda, we have Kita, which is a subsidiary of the Chinese giant Meituan. And the competition is really intense here. If we take a step back, we see that Kita entered Hong Kong in 2023, and they really grabbed market very quickly with all these market share, with all these promotions and discounts. And unlike Kita, Deliveroo has always focused on these higher-end premium prices restaurants. So it's a different kind of target audience there. And just to give some numbers, we see the average order per Kita's order is about 120 Hong Kong dollars, and that's $60 cheaper than Deliveroo and Foodpanda. So, but the CEO of Deliveroo insisted they will not keep lowering their prices and do price wars just to keep surviving in Hong Kong. But the reality we've seen is that Hong Kong is really sensitive to all these discounts and promotions. That's why it's a really tough market for Deliveroo.
Yeah, so can you talk a little bit more about that, this expansion of Kita?
Yeah, so Kita is part of Meituan. It has its initial success in China and recently have been expanding very aggressively overseas, especially in Asia and in Middle East. We see it recently entered the Saudi Arabia market in September and quickly acquired more than 1 million weekly active users as of January. And we see that affected in the Meituan stock price as well. It almost more than doubled in the last 12 months. So it's really like a growing success story with heavy promotions, of course.
You also have a really nice story out today on Hong Kong's elite educational institutions pivoting to try and target wealthy Chinese families instead. What does that tell us about the shifting landscape in Hong Kong?
Yeah, so there's a bunch of elite international schools that are offering bilingual Mandarin programs, and what that means is that they will be starting teaching students half of the time in English and half of the time in Mandarin. And before that, Mandarin was taught as a language class, but now it's teaching everything. So it's really a broader landscape story because you see in the past few years a lot of Western expats left Hong Kong, and on the other hand we see a lot of inflows of the mainland rich Chinese immigrants, and they're the top holders of the top talent visa scheme, and in order to get that visa you have to be either highly educated or have a high income. So to some extent, it's an economic-wise decision for these schools to pivot their focus on the mainland inflow of the immigrants. So we've seen the schools have been telling us it's super popular for the bilingual programs these days. A lot of them are oversubscribed and have to do lotteries to decide which kids to get in.
Yeah, sounds like the IPO market here. How are different parents reacting to this?
So, of course, different parents have different perspectives. We see even some expat families, some of them welcome the change. They said that Mandarin is one of the most widely spoken language in the world, and it's very helpful for their kids to have networking and build a career in Asia. But we do see some Western expat families, they're complaining it's kind of overwhelming because, Mandarin is a tough language, and also it's kind of overwhelming the kids because Chinese parents ask a lot of homework and extracurricular activities. But the schools have emphasized to us that adding Mandarin doesn't mean that they're diminishing their international values, because they still celebrate all kinds of festivals from all over the world, like Christmas, Chinese New Year, Halloween, and etc. So, yeah.
Yeah, it's just more holidays, right? If you think about it. Okay.
And possibly more homework. This is the other side of that coin.
Well, yeah.
Right?
So one offsets the other in terms of free time. Diana Lee, thank you so much. Our wealth reporter there. So yeah, we talked about this really shift in Hong Kong taking place, the changing consumer habits, the next generation, of course, this visa scheme that's come through. So you can check out, by the way, our Insider's Guide to the Money and People shaking up the finance hub in our Hong Kong edition newsletter. And the other thing, by the way, that blew up in my groups, at least here over the weekend, was Tasmania Ballroom, which was a staple on the Hong Kong nightlife, also closed its doors on the weekend. I think Rebecca's about to say...
You, in fact, took me to Tasmania Ballroom for the first ever time.
Okay, and the last ever time.
And last, yeah, first and last.
There we go. And that story stays that. Okay, there we go. You can sign up, Bloomberg.com/news. Plenty more ahead. This is The China Show. Right, welcome back. So here's a crazy statistic. You guys have probably heard about the rout in equities, that U.S. equities have completely retraced now the gains since either the inauguration or the election. Markets, of course, look forward, so they started rallying ahead of, in fact, the inauguration. So what it's done is the collective net worth of U.S. billionaires has really seen quite a tumble this year so far. So it's been a bad year for billionaires. Year to date, the top 20 have seen their collective wealth erode by over $200 billion here.
Yeah, and it really is quite a remarkable turnaround when we think about where we started. Those kind of quite iconic images of President Trump at his inauguration, flanked by America's, or some of America's at least, biggest billionaires, and this sense of elation that was also kind of rippled through the rest of Wall Street. All of Elon Musk and co.'s DCM bankers, ECM bankers kind of thinking about what deals now might be in store.
Yeah, and it's interesting because as far as the news flow goes, right, we'll tie it back together, that we understand that President Trump is going to meet, of course, U.S. tech leaders on Tuesday. And it's interesting juxtaposition with President Xi meeting his own group of tech entrepreneurs. And it's almost like this is that strategic rivalry. Like, they're gathering their troops on this AI conversation. Yeah. Elon Musk, of course, almost sits in between because you have this Tesla story, and he probably just showed you the 190 billion poorer. He's now just worth $300 billion US dollars, Elon Musk.
I mean, and on Elon Musk, interesting that China is one of the only markets where he's not seeing some of this backlash in response to, of course, the political role that he's playing in the Trump administration.
Yeah, although that's playing out as far as the business goes, right? This piece that we put out last week where it's a fundamental story on the BYD.
He's facing that rapacious competition from some of the other EV leaders in China. Yeah.
There we go. Yeah, stock is down 50%. Speaking of competition from the likes on your screens. Very quickly, as we go into the last hour of trade here, the Hang Seng Index, quite a morning. It's had massive amounts coming through again across the southbound connect. And we're here, down 0.8 to 1%, 90 minutes into the session. That's it from us. We'll see you all tomorrow.